Hey, it's Rick with weekend market recap for Sunday, March 12th. I waited till late in the day today because I wanted to see how the futures market opened in reaction to the Silicon Valley Bank bankruptcy. But I'll get to that in a few minutes. Starting as we always do with the risk model, again, it's just completely flip-flop. This has been a very volatile market for the last month or so. Now totally solidly red, whereas we had turned green a week ago. And this is just the way things happen. I'll get this out of the way. When you get price right around the 40-week moving average or the 200-day moving average, it just can't make up its mind on a direction. And so I've talked about this in several videos. This is the kind of chop that I was expecting and can just chop up your account if you're in and out, in and out, in and out. So, I mean, there was some signs here. We could have got, I think I said 25% invested, perhaps even 50% invested. But if you're adopting my sell rules, again, when it hits closes here below the 40-week moving average, you're out. So you're out for a relatively small loss on only a quarter of your account size. So it's nothing you can't recover from. Where we go from here, again, longer term. This chart, this part of the chart right here, this is the weekly chart here of the S&P 500 is very reminiscent of the 2003 period when we had the peak in 2000, and then it came down. We got into this bear market, and it looked like it was recovering. And I went to MarketSmith and had a look at it earlier. I'm not going to bore you all with it right now, but if you have access to charts that go back, it's worthy of looking at it. And so it looked like it was going back up, and then this failed. And the upshot of it was it just continued to go straight down for next 2 or 3, a couple of years. If we follow the same pattern, the market dropped, I think, a total of about 30%, which had the equivalent of taking us from the 400 level here down to the 300 level here. So that's not inconceivable. So again, as I've been saying for a long time, cash is the place to be, so who cares? It's just going to give us an incredible buying opportunity at some point. The other thing is this could be a tradable bounce. We're still in a bear market, so we could get a bear market rally. We could get a bounce up here before we come chopping back down again. But again, unless you're a stock picker, stay out. Just stay in cash because you have to be very nimble to take advantage of this kind of a market. And so that's second reason for being in cash. And the third is if we do turn around from here and we do get into a bull market, we're going to go up nicely. Yeah, you might miss the first 4, 5, 6% of that move. But in the long haul, let's just go back here. That's like, getting in here instead of getting in here. You give up a little tiny bit, but look at what you gain. So that's the potential. So bottom line, for no matter which way the market you think is going to go for the next 4 or 5 months, I think cash is the place to be. Unless as I say, you want to be going with anything on a short-term basis. Friday, I got down to about a 12%, looking at the daily chart over here, just on the S&P 500. On this day here, Thursday, I got down to, actually, no, it was this day here. I got down to about only 12% invested. And we stayed that way, tried a little bit of bottom fishing on Thursday, got stopped out for some small losses. And then I entered a few bottom fish, what I call bottom fish positions on Friday. So, but they're with very, very tight stops. But what I focus on is companies with great sales and earnings. I think I have 1, 2, 3, 4, 5 companies But I mean, all are showing earnings growth of 30, 40, 50% each quarter for the last 3 quarters, sales growth in high numbers as well. So very strong earnings, potential growth. So I figure if those companies can't hold up, I mean, everything's going to go down, but if they can't really hold up, and I'll just show you a couple of the charts. AIT, which is $5 billion machinery tool company. Just going to a weekly, see it's holding up really well compared to the S&P 500. So I'm bottom fishing here a little bit, thinking, but with very, very tight stops. So if it gets below here, we're out, and I'll have to rebuy it at some other later point. Same thing with LGM, which is a semiconductor company, $8 billion market cap, huge earnings growth. So it's holding up really nicely too. So I entered this way down here on Friday with a stop right here. So you could do this kind of thing, but you really have to be nimble and be more content with 2, 3, 4 day gains, which is not the bag of tricks for most of you. So again, just to reiterate, so getting back to the futures, it looks like the government has made an announcement just about 20 minutes ago that they're not bailing them out, but they are protecting the depositors. And so the depositors are going to have full access to their money on Monday, which is really important. I mean, just think about it. If you're a small company owner right now and you got payroll coming up Tuesday or Wednesday and you can't access your bank, what the hell do you do? So at least they're going to have access to their money. No, they're going to obviously all pull it out of Silicon Bank and money's going to move to other banks. But at least the depositors for now are protected, which is a really good thing. It's having a very positive effect on the futures, but I mean, we've got a long ways to go between now and 6:30 tomorrow morning. But right as we speak, the NASDAQ and the Russell are up almost 2.5%. So fingers crossed that we hold that for tomorrow morning. And we'll see some, but we need to see more sustainable positive moves in the market before we're going to get, even on a day swing trading basis, before we get too aggressive. There's just so much volatility right now that it's just not a safe environment to be in. So that's my take on that for now. I'll continue to scan for companies that have very strong fundamentals, good sales growth, good earnings growth. Relatively, I want to focus on the small caps. I think the money will flow back into the Amazons and the Apples and the Googles and stuff like that because it's safe or deemed to be safer, and there's certainly more liquidity. But I think their glory days are behind them. So I'm going to focus more on the small and mid caps. Okay, that's it for now. Stay safe, everybody. Hope you all do well. Cheers.